A dark pool is a private trading venue where large investors, such as hedge funds, pension funds, or banks, can buy and sell securities away from public stock exchanges. In simple words, it is like a hidden marketplace where big trades are executed in secret so they do not immediately affect the visible price in the open market. The origins of dark pools go back to the 1980s, when large institutional investors argued that they needed a way to trade massive blocks of shares without causing sharp price moves. If a pension fund wanted to sell 10 million shares of a company on the New York Stock Exchange, the visible supply would likely push the price down before the trade was completed, costing the seller money. By creating private venues where trades could be matched quietly, investors could reduce this market impact. Over time, technology and deregulation allowed these venues to grow, and by the 2000s, dark pools had become an important part of global equity markets. How does a dark pool work? Unlike on a public exchange, where buy and sell orders are displayed for everyone to see in the order book, in a dark pool, the orders are hidden. Participants submit their orders, and when a matching order appears, the trade is executed anonymously. Only after the trade is completed is some information reported, and even then often with delays or only aggregated with other trades. This opacity is what gives dark pools their name. The advantages are clear for large players. They can execute big trades with less risk of moving the market. They also often pay lower transaction costs compared to traditional exchanges. For long-term investors like pension funds, this can mean billions saved over time. But there are also disadvantages and controversies. Because dark pools are not transparent, critics argue they reduce market fairness. Small investors trading on public exchanges cannot see the full picture of supply and demand if much of the trading happens in the dark. This lack of transparency can lead to fragmentation of liquidity, where prices on public markets no longer fully reflect true activity. Another concern is the role of high-frequency traders. Some dark pools have been accused of allowing fast traders to exploit slower participants, taking advantage of their information even though the venue was supposed to protect them. This has led to lawsuits and regulatory scrutiny, especially in the United States and Europe. A famous moment of public attention came in 2014 when Michael Lewis published his book, Flash Boys, which alleged that high-frequency traders were exploiting dark pools to the detriment of regular investors. The book sparked debates about whether dark pools truly serve their original purpose or whether they mainly benefit a small group of sophisticated players. Still, despite criticism, dark pools continue to play a large role in modern finance. In the United States, for example, they account for around 10 to 15% of all equity trading volume, depending on the period. They are particularly important for block trading, where institutions need to move huge positions discreetly. A curiosity is that the term dark pool sounds mysterious, but in reality, it simply refers to the lack of pre-trade transparency. There is nothing illegal about them. They are regulated, though often under different rules than public exchanges. Regulators try to balance the benefits of reduced market impact with the need for fairness and transparency. In conclusion, a dark pool is a private marketplace where large investors trade stocks anonymously, reducing market impact but raising concerns about transparency and fairness. They are a key feature of today's fragmented financial markets, showing how technology and investor needs continually reshape the way securities are traded. Above, you can find more videos to keep learning about law. Remember to give us a like and subscribe.